Gold is approaching a massive liquidity zone right now, and smart money is already preparing their next move. In today's explainer, my primary focus is a very specific setup targeting key liquidity pools, but there's one strict condition that absolutely has to happen first. We're skipping the fluff today. Let's dive straight into the institutional order flow.
44,390, write that down, because that's the exact number we're watching. This is our primary buy-side liquidity target for today. It's literally a massive pool of resting stop-loss orders, and institutions are actively drawing price right toward it as we speak. The thing is, most retail traders, they're looking at completely the wrong levels right now, getting trapped in that lower time frame noise. I'm going to show you exactly where institutions are actually targeting and how we plan to capitalize on it.
So let's lay out the exact trading plan right up front so you know exactly what we're looking for. Our daily bias today is a bullish retracement. The primary setup we're hunting is a long position from a discount fair value gap, an area of pricing imbalance where institutions are likely to step in at a highly favorable price. As I mentioned, that target liquidity is sitting at 4433.90 and stretching all the way up to 4060.00. And of course, our hard and validation level is 394.00. Okay, so you have the outcome. Now let's break down the institutional reasoning behind this whole plan. If we zoom out to the 4-hour time frame, you'll see that while the overarching daily macro structure is definitely still bearish, we're currently operating inside a pro-trend bullish retracement phase. You see, smart money recently swept major sell-side liquidity all the way down at 39.64. And right after that sweep, they established a higher low and delivered this really powerful upward displacement. They're driving price directly into a premium array, basically an overvalued zone that's just ripe for institutional repositioning. Now, dropping down into the 1-hour time frame, that bullish market structure shift becomes super clear. We've got higher highs and higher lows locked in. There's strong displacement pushing the price right up into the premium of our current dealing range. Institutional order flow is actively stepping in to protect those higher lows, and they're consistently breaching equal highs. That tells us without a doubt that smart money has been accumulating heavily on these dips. But here's the crucial point. You have to understand what actually fuels these technical moves. Our technical drivers are directly connected to today's geopolitical and macroeconomic headlines. On the technical side, obviously, we have our buy-side liquidity pools and those fair value gaps. But fundamentally, we are dealing with intense geopolitical tension. We're talking about the 10th consecutive day of US CENTCOM strikes in Iran, plus those Houthi maritime blockades causing serious market volatility. Add in high-impact data like the USD ADP and GBP employer releases, and you've got a perfect storm. And here's an institutional reality that might surprise you. Over 80% of retail traders completely misunderstand fundamental news. The truth is, volatility is engineered specifically to sweep liquidity. Smart money isn't using these geopolitical catalysts or economic data drops to just randomly flip macro trends. Not at all. They use that resulting volatility, the headline panic, the sudden retail rush, to generate the immense volume they need to push price exactly into their predetermined institutional targets. It's highly calculated. So, bringing it down to the 15-minute execution time frame, this is where the actual opportunity really comes into focus. Right now, price is just overextended. We are aggressively pressing into short-term resistance. So what we need to do is locate the exact fair value gaps and order blocks down in a discount array. That's exactly where institutions are most likely going to reload their long positions for that next leg up. Here is the exact institutional sequence we absolutely require for our execution today. Step 1, we want to see a clear sweep of that buy-side liquidity at 4,043.90. Step 2, right after that sweep, we need a retracement back down into our 15-minute discount fair value gap. Specifically, we're looking between 4,022 and 4,028. And finally, step 3. Inside that zone, we wait for a 1-minute or 5-minute change of character. We need a clear shift in short-term momentum backed by strong displacement. Your patience here is absolutely critical. This exact sequence has to unfold before we even think about clicking a button. If that sequence does trigger, here are the precise executable parameters for the trade. Our entry zone sits firmly between 40.22 and 40.27. We tuck the stop loss safely below that swing low at 40.11.50. For targets, we'll take our first partial profits at 44.44.00, and we'll leave a runner for that ultimate 4-hour fair value gap fill at 40.60.00. This setup gives us a highly favorable institutional risk-to-reward ratio of about 1 to 3.2. It's a very solid setup. But here's the problem. Where exactly is the trap? You know, every high probability setup comes with a phase completely designed to liquidate impatient money.
This is the scenario most traders are completely ignoring right now, and it's exactly where retail is most likely to get absolutely crushed by smart money today.
Let's compare the two mindsets here. The typical retail perspective is to just buy the breakout the absolute second price crosses above that resistance at 43.90. But smart money may be targeting something completely different. Their perspective? Wait for that 43.90 sweep to induce all those breakout buyers into the market, use that fresh, newly minted liquidity to take profits on their early longs, and then aggressively push the price right back down into the 40.22 discount array. Retail gets trapped holding the top, while institutions just reload at the bottom. It happens every single day.
And look, because we trade probabilities, not certainties, this next level becomes absolutely critical. 3994.00 is our hard invalidation level. If we get a 1-hour body close below this mark, it's over. It entirely destroys the bullish retracement structure we're looking at. It tells us the institutional draw on price has shifted, and strict risk management dictates that we just cut the idea immediately, no questions asked.
Actually, the market is sending a pretty clear warning signal at this very moment. Because despite our clear bullish bias, there is absolutely no trade to execute yet. I'll say it again. We have no valid institutional confirmation. We do not chase price up into premium zones, period. We sit on our hands, stay disciplined, and wait until that 15-minute confirmation actually appears inside our designated discount zone.
All right, let's do a rapid final recap of today's institutional plan, so we're all on the same page. Our bias is a bullish retracement. The absolute best probability entry zone rests between 40.22 and 40.27. Our primary liquidity targets are 40.43.90 and then 40.60.00. And our non-negotiable rule for today, you have to wait for that lower time frame change of character with displacement. If you appreciate this level of clear, no-nonsense institutional market analysis using ICT and smart money concepts, go ahead and subscribe to ICT Market Theory. We keep it precise, we keep it objective, and we focus purely on how institutions actually deliver price. And if you'd like to trade alongside these setups on a highly reliable platform, you can find the FXTM account link down in the pinned comment below. So stay disciplined today, wait for your precise targets, and just let the market come to you. Are you going to be the liquidity today, or are you going to trade alongside it?